Hello, everyone. Can you hear me? All right. So I'm Nevin. I'm the co-founder of Reserve, which is a full-stack open currency, and I'm going to explain what that means in a minute. We have a team of 20 based here in the Bay Area, and some exciting Silicon Valley backers. And this talk isn't really actually about Reserve. I want to talk to you guys about some of the things that we've learned about what we think is going to happen in cryptocurrency in the coming years that I think are really important to understand, both if you want to predict what's going to happen or if you want to get involved and build things in this open currency movement. So to start off with, I want to spend a minute talking about what money is fundamentally. I think this is a really important point. So I came from a sort of small hippie town where everyone thought that money was bad, and if you had money, you were sort of greedy or evil, and it was sort of the source of problems. And so I think that you can't really understand what money is unless you think about what the world would be like without it. So if you imagine a situation where we don't have the ability to use money, I think that what that leads to is people can really only pay back favors for others within a small group, because everyone can sort of keep track of who's done favors for who. But if you think about it, everything that's going on around us, like the fact that this conference is allowed to use this building, the fact that people got together to build this building, those are all favors. Those are all things that people did for other people who weren't necessarily their friends, weren't necessarily a part of their social group. And it's kind of amazing that this works. And the reason why it works is because we sort of have this simple record of who's done favors for who. And so then those favors can be paid forward instead of paid back inside of a small group. And if you think about that, that's a really powerful thing. That's, money's really about cooperation when it works well. And so then in this context, we can think about what is inflation. Inflation is sort of the degradation of that record of favors. So you've done some favors for people or groups, some part of society, and then if your purchasing power is going down, then that record of the favors that you've done is kind of slowly going away, and your ability to call in those favors is going away. And so there's like 16 countries right now with 20% or higher inflation, and really what that means is that those people are living in fundamentally less cooperative situations than in scenarios where the money is not inflating at that rate, which is like, it's a pretty big deal, I think. And so we've been thinking about how to create what we call a full stack open currency, because we think cryptocurrency is this amazing opportunity to try to sort of augment or even in some cases replace those inflationary currencies and sort of enable a bunch of cooperation in those scenarios that can't exist now. And so a full stack open currency is basically a cryptocurrency that has all the different features necessary to actually be a good substitute and work like money. So it has to be easy to store. It has to be the case that it can't be stolen, and if you lose your keys, you can get them back. It has to be cheap and fast to transfer, so that it's practical as a means of exchange. It has to have a stable purchasing power, again, so that the sort of record of favors is staying stable. It has to be censorship resistant. It has to be adequately private, and then importantly, it has to be impractical for criminal use. If the currency is very practical for criminal use, enables lots of money laundering, we think ultimately it will be banned and won't be a very good mechanism for the world. So I want to hone in on a particular set of lessons we've learned that I think people need to understand if they're going to predict what's going to happen in the future of cryptocurrency. So this is how we go about assessing stability mechanisms. And I'm going to sort of lead you guys through some basic building blocks that are crucial to get. So there's 4 things. You have to understand market depth charts, buy walls, sell walls, and arbitrage. We'll go through these one by one. So a market depth chart, you guys have probably seen this if you're into crypto trading. Essentially, you have the orders where people are willing to sell the currency and orders where people are willing to buy the currency. And you can see sort of these lines here are people willing to sell a large amount at that price. And then if there's a scenario where there's like a horizontal line, that's because no one's offering currency at that price. Okay, so that's basically what this market depth chart means. And so now with that in mind, we can think about what is a buy wall. A buy wall is just when someone is willing to buy a large amount of the currency all at the same price. So you get this big wall in the chart. And so what that means is that if someone wants to sell a bunch of that currency, at that current market price, that won't cause the market price to go down for a while until they've sold enough to eat up that entire wall, right? So it keeps the price at least temporarily stable. And then the same thing with the sell wall. It's just on the same thing on the other side. Someone's willing to sell a lot at that price. And so people could buy more and more and more. And until that whole order is taken, until all of that currency is sold, then that market price won't move upwards. OK. So, and then the last piece is arbitrage. This is a simple concept that people sometimes get a little bit wrong. So the way I think of arbitrage, it's not just the ability to buy something low and sell it high. It's the ability to buy it low and sell it high at the exact same time, which provides this sort of risk-free profit. And so putting these all together, we can sort of think about what an exchange rate peg is. And that's sort of the crucial piece in assessing any of these stability protocols, which is a core piece of these new currencies being generated. So an exchange rate peg is a situation where some market participant is willing to provide a huge buy wall and a huge sell wall at the same price so that nobody can move the price on that market no matter how much they're buying and selling. And then with arbitrage, you get all of the other markets coming into line because if the price is different on some other market, someone can buy somewhere and sell somewhere else and make risk-free profit. But since you can't move the main market that actor is acting on, they all come into line with that main market. OK, so going through this kind of fast, but think about that later if that didn't all make sense. This is crucial to understand. So this allows us to think about how pegs break. Essentially, if that buy wall or sell wall runs out, now the price can move. And that's all it means for a peg to break, is that buy wall or sell wall is gone. And so if you can think about like a small country that's pegging its currency to the dollar or the euro, if they run out of their own currency, which they normally wouldn't do because they can print as much as they want, or if they run out of whatever asset they're holding in reserve, be it dollars or euros, then all of a sudden they can't provide that buy wall or sell wall, and that price can move. And that's really all it means for a peg to break. So this is really cool because this means that we can actually have this very simple framework for assessing a peg and deciding whether it's sound. Okay, so number one, you have to think about the value of the assets held in reserve, because that's basically what allows that actor to put up that buy wall and that sell wall. And then the credibility of the promise to spend those reserves defending the peg. Okay, so it could be that the country or the person has lots of assets, but they choose not to spend them to defend the peg, in which case that buy wall or sell wall goes away and the price can move. So we can then apply this to all of these stablecoin designs that are coming out. And the way that you have to do that is you have to look at a stablecoin design and think about what is the implied reserve. In this scenario, what is effectively taking the place of the reserve to implement the exchange rate peg? So we'll do that briefly for a few popular stablecoin designs to try to communicate how we think about this. So number one, simplest is Tether, right? So the value of the assets held in reserve is just going to be the total number of dollars held in Tether's bank accounts. And so let's assume that that's sufficient. So OK, check mark. And then there's the credibility of the promise to spend those assets maintaining the peg. This is a little bit difficult in Tether's scenario because it's hard for them to publish audits. It's hard for them to sort of credibly signal that they will always mechanistically spend that money to maintain the peg. And that's, I think, why people are not exactly that trusting of Tether at this point. We can do the same thing with the Maker protocol, which is a really interesting protocol. And but this gets a little bit more complicated. So if you look at the value of the implied reserve in the Maker system, essentially anytime the price of the DAI token is less than $1 on the secondary markets, in theory, speculators will come purchase that token with the promise of being able to redeem it for collateral later. And so then you can just think about, OK, how much money do all of those speculators have that they're willing to spend? It's kind of like a decentralized central bank reserve account. And then for the credibility of the promise, how reliably will they spend that money in order to buy that token to bring the price back up, which essentially is what's providing the buy wall. And then I'll do one more real fast. So Basis is another popular protocol. In that scenario, you can also translate it into this framework pretty nicely. So for the size of the implied reserve, you just have to look at the number of dollars worth of base bonds that can be sold at any given point. Right? So that's the size of the implied reserve. And then for the credibility of the promise, again, it sort of goes back to how reliably are those speculators with those dollars out there or other cryptocurrencies going to be willing to spend that money to maintain the peg. And so this is a framework we've used in assessing lots of designs and coming up with the design that we have ourselves. If you're curious about that, come talk to me afterwards. So Reserve is coming out of what's called the effective altruism movement. And the effective altruism movement is this really interesting group of people that sort of looks for clever ways, like high efficiency ways to somehow substantially improve the world. And so the reason why EAs, as we call them, are interested in coming and doing this project, there's sort of two reasons. One is this sort of direct impact that can be had with replacing inflationary currencies and potentially providing this ability to cooperate to tons and tons of people around the world. And then the other is that there's a popular notion in effective altruism that's called earning to give, which is basically doing some project that will make you some money and then spending that money on some particular cause. And so I threw this slide in here just because if anyone in the room is familiar with EA, that might make you more interested in coming and working with us. If you are interested, there we go. If you're interested in getting deeper into the open currency movement and sort of discussing these ideas in detail, I encourage you to send me an email, nevin.freeman@reserve.org, or just go check out our website and email the main contact. We are organizing monthly salons in the San Francisco area to sort of talk about the hard problems that have to be solved to make this really work. And if you're an engineer, you should consider coming and working with us. Like I said, we have a 20-person team with engineers from Google and OpenAI, Machine Intelligence Research Institute, and other startups. We have more work to do. This is a really big project. So we have a couple more minutes, and so if anyone has any questions, I'd be happy to take those.
Questions for Nevin? One right over here.
It's just real simple. Can we get some hints about how the currency works?
Sure. The reason why I decided not to try to explain it here is that it's a bit complicated. But the basic notion that is important to our model is we think that it's important to have assets locked up in a contract that can basically function as a reserve. So we think that with a lot of these stablecoin protocols, one of the issues kind of in the framework that I mentioned is that you can't really tell what the size of the reserve is, and you can't tell how reliably those people are going to choose to spend the money. And so sort of the fundamental notion in our protocol is to lock up a bunch of crypto assets in advance and then have very simple code that anyone can read so you can see that those assets will always be spent defending the peg.
Great. We have time for one more question.